My name is Mike Singh. I'm the CEO of AsiaKredit, which is a Singapore-based entity. And we run our business operations in the Philippines called Pera 247, which is a mobile lending app. So Richard today asked me to talk about alternative data and alternative lending. And we are, I guess, we heard from a lot of big corporations like Union Bank and Global Credit Pros. We are a pure startup. We started just a little over 12 months ago. We have 50 employees. We live on 6-month funding, from 6 months to 6 months. We never know when the next 6 months is going to be, we're going to be around, right? So this is a true classic case of a fintech startup trying to disrupt the banking space. So hopefully you can see some of the slides here. I tried to keep it to 10 slides. It'll be quite dense, and I'll try to go through it with you. So I don't need to repeat what's on this page. I think we heard a lot about this most of the morning. There are approximately 50 million hardworking Filipino adults that don't have access to formal banking services, right? That are either underbanked or unbanked. These are actually names of existing customers. Obviously, these aren't their pictures. But let's take the 3 scenarios here, right? Why do we have such a large unbanked population? So Aling Puring, a sari-sari store owner, she's self-employed, but she has no bank account. She has no income tax return, right? Income tax return is probably the first thing a bank is going to ask you when you're applying for a loan. Kuya Robert, a wet market vendor, has no payslip, right? He collects cash. He has a steady income. He has no utility bill or postpaid bill. He uses a prepaid phone. So again, he has no history of records. We heard that again this morning, right? Simon, a call center agent, probably the most savvy among them. He does have a bank account, but the minute he gets his payroll, that money is wiped out, right? So he doesn't have a minimum ADB. The bankers here know what that is, average daily balance. Banks will look for an average daily balance in order to provide you with credit. So what we have here on the right is the Philippine income pyramid. And you can see at the top, the affluent, which represent a very small part of the overall households of the Philippines, are what we call the banked population. And below that, we have the underbanked, and the very bottom of the pyramid is the unbanked, earning minimum wage or even less. So why do we have this problem, right? So in the Philippines, there's a lack of credit bureau data. We talked about all the records that are not available, right? When banks make a decision, they need records. They need tax returns, they need postpaid bills, they need utility bills, they need proof of address. Limited lended know-how in predictive analytics, right? Banking uses traditional demographics, right? Name, age, address, income, dependents, etc. Expensive and time-consuming manual verification. So the cost to do underwriting or credit risk evaluation on a 50,000 peso loan is the same as it does to do a 2,500 peso loan. And when you're talking about the most bottom half of the pyramid, based on a payment to income ratio, they can only afford a loan of up to 2,000 to 3,000 pesos, right? So does the bank have the infrastructure, the cost infrastructure, to be able to underwrite a loan at that size? And finally, no risk-adjusted pricing. Obviously, it's a much riskier demographic, being at the lower half of the pyramid, and the ability to assess risk and price for that is something that's not yet very prevalent in this market. And yet, when you look on the right side, in the green boxes, you can see the Philippine market is doing very well and is a very robust nation, right? 13th most populous nation in the world, 60 million plus millennials, very strong GDP growth, as you all know, one of the best in the world right now. And then look at the red boxes, and yet we only have 15 to 20 million bank accounts in a country with 60, 70 million Filipino adults. And worse, we only have 3 million credit cards. That 3 million credit cards has probably been the same for the last decade, right? When I was in banking here in the Philippines, the strategy was steal market share, not grow market share. Because in order to get a credit card, you need to have a credit card, right? In terms of GDP, again, we're at the very low end in Southeast Asia, 9% of GDP in consumer debt. We have markets that are Thailand, Indonesia, 20, 30% of GDP. So we have a 2-3x catch-up in terms of consumer debt. But the World Bank, we've talked about financial inclusion all morning, right? And the World Bank says that there are basically 4 parts of financial inclusion. And these are all key enablers to reduce extreme poverty and boost shared prosperity. And you can see on here, it's savings, payments, credit, and insurance. Good example here is bottom paragraph on the right. As account holders, people are more likely to use other financial services such as credit and insurance to start and expand the business, invest in education, health, manage risk, and weather financial shocks, which can improve the overall quality of their lives. So I'm sure everybody in this room has access to credit, and you can see how valuable that is to you, right? Whether you use your credit card to tie you over to your next payroll, or you apply for a loan to get you a refrigerator, a microwave, or washing machine, right? Everybody needs to have access or deserves the right to have access to these types of goods and services. So what if we could use alternative data to score the bottom half of the pyramid, right? So if you look on the left side here at the very top, as I mentioned a while ago, for decades, hundreds of years, banks and financial organizations have used traditional demographic scorecards. Income, age, I mentioned this, education. Today, we talk about the digital age and digital footprint. What if we could use these types of information, which many people, or majority of the population in the Philippines, have footprints of? So if you look on the right side, the Philippines, as you know, is one of the fastest growing digitally penetrated markets in the world. I think overall we spend the most time on Facebook than any other country in the world. Smartphones are growing at a 20% clip year on year. I think we're at 50 plus million now. So there's a very robust digital footprint that we can leverage to assess credit risk for the bottom half of the pyramid. So who are we? I mentioned we're a startup. We like to say that we are an instant loan through a smartphone app. Essentially, what a customer does is they download our app on the Google Play Store. They answer 5 to 10 questions. Upon answering 5 to 10 questions, we ask for consent to swipe data off their mobile device to use in credit risk assessment. When they hit yes, in 60 seconds, we swipe 50,000 data points off a mobile device. And yes, every mobile device has 50,000 data points that represent your digital footprint or your behavior. We send that data to our cloud servers. We have an algorithm that predicts probability to pay, and we return a decision of approve or decline in a matter of seconds or minutes. Upon approval, we fund an electronic wallet. Now, obviously, in this market, 98% of transactions are still cash. With that electronic funds, you can buy online, you can pay bills online. But again, 98% of our customers need cash. So we have partnerships with 30,000 organizations, cash points across the Philippines, like Cebuana Lulier, who's here, 7-Eleven, Western Union. So you walk into one of those, you give a unique reference code, and you can pull out cash. And repayment would be through the same channel. So, we spent the last year really in what we call the pilot phase, building our scorecard. So in order to build a digital scorecard, you actually have to give out loans that you expect to go bad, because you need to know who the bad guys are or defaulters are in order to build that scorecard. So we considered last year to be a pilot. We did fairly conservative volume. We dispersed about $1.5 million in loans. And if you think about an average loan size of 3,000 to 5,000 pesos, that's about 20,000, 30,000 loans. And what we decided to do in the space, we really envision ourselves to be a full spectrum consumer finance player. So if you look at the bottom, this is the product roadmap, right? And we see the Philippines today, on a per capita basis, only $90 represents consumer debt. You look at markets again like Thailand and Indonesia, they're upwards of $400 or $500. So we expect the market to grow up to 3 to 5x over the next 5 years. So we're looking at a consumer finance asset class of about $100 billion in the Philippines over the next 5 years. And this is our product roadmap. So we spent the last year, 2018, launching our payday product, which happens to be the riskiest segment of the population. We're launching our cash loan next month. We're going into the sales finance space also in April. I'm glad to see the home credit guy left because they're a big competitor. And then eventually we want to do a revolving credit line. So everybody, I'm sure, is thinking now, okay, how do you do risk, right? And this is what Richard asked me to focus on. So you probably have seen this before. It's an evolving trend of using mobile device data to predict probability to pay. So the typical stuff that you find on a cell phone, you can see on the slide here, right? What websites do you visit? What cookies are on your phone? What music do you listen to? How large is your contact book? How many email accounts do you have? What are the age of your email accounts? Do you use a calendar? Do you actually delegate your calendar to somebody else? How many meetings do you have? How many missed calls do you have? Do you trip off your GPS device? So these are all what we call digital footprints that predict or that are a digital footprint of your behavior, right? So we use all of this data, and essentially on the bottom left here, we have a 4-parameter customer identification, or KYC, including an OTP, facial recognition, email validation, et cetera. National ID, we allow about 5 to 6 different government IDs. We have a SIM age check for anti-fraud, right? So a fraudster will chuck out it's very easy to replace a SIM card, right? They cost $50. So I get declined, I throw away my SIM, I buy another SIM, I apply again. When we launched this business, we had borrowers that were borrowing up to 10 times a day with a different SIM card, but guess what? We have their device ID, right? It's much harder to throw away a cell phone. So you use the same cell phone, you replace your SIM card, but we know it's the same person that's applying. And we use a combination of the application data, the data that you enter, and the digital footprint to produce a stable forecast. So about 90% of the decisions we make are automated or machine decided. 10% of that goes to manual verification, which we can do in a matter of 3 minutes if you pick up your phone. So without giving up too much proprietary data, again, there are competitors in the room here. I asked my risk guys to disguise as much of this data as possible. So this is very generic, but again, it just gives you an overall sense of how we do credit risk. So these sample digital footprints improve default by up to 1.5 times. So the first one, location-based. So again, I mentioned, do you trip off your GPS flag, right? If yes, you fall into one bucket. If no, you fall into another bucket. You get a specific score. What are the applications installed on your cell phone? Do you have an e-wallet on there? Do you have a banking application? What are the other applications you have on your phone? What are your recreational activities? Do you have a sport tracker? Do you have a lot of games? Do you play a lot of games? Maybe I'll just share this, but those who play Candy Crush tend to have a default 5 times worse than those that don't. So, and the last one is genres. What type of music do you listen to? Believe it or not, right? And some of this is intuitive, right? If you trip off your GPS flag, you likely travel, right? You probably have better income. That's an example, maybe a bad example of something intuitive, but most of it is really statistical regression and correlation, right? Certain people that behave a specific way will have a footprint similar to somebody else that behaves in that manner, right? So you put all of that data together and you build your what we call your scorecard. So on the left-hand side, you can see here is the makeup of our scorecard. And you can see that 70% of the predictor fields that we use come from the digital data on your smartphone. Only 30% come from traditional data. So that's the stuff you enter. My name, my employment, my address, my dependents. So mind you, our process is fully digital. We don't see your face outside of the selfie you submit in your ID. We don't ask for a pay slip, an ITR, nothing like that. We don't ask for utility bills. So the thing with digital data is it's hard to fake that stuff, right? It sits on your phone. You can delete as much as you want, but there's still stuff that's sitting on your phone that we can detect. You can lie about your income. You can lie about many things, but again, a digital footprint is something that is historical, it's very dense, and it's hard to fake. So you put that all together on the right. What we do is we take our borrowers. I mentioned last year we called it a pilot phase where we built our scorecard. So we took all of our borrowers and we split them into 5 different groups. And we came up with the scores for each of them based on those digital parameters. And what we found was the ones with the best scores had 2.5 times lower default than those with the worst scores. So essentially what that says in a very high-level way is that digital footprint is a good predictor of risk. So what do we have, right? At the end of the day, this is a snapshot of our customer profile over the last year. Previously, underbanked or unbanked hardworking Filipinos, many like you and me, are now creditworthy, right? So you look at the stats here, age group, marital status, only 10% are business owners, 90% are employed. You look at the monthly income, I mean, these are people that would not even step into a bank, right? Much less would have any money to put into a bank. 70% of them are unbanked, so have never had a bank account, or are what we call first to bank or first to former financial services. And you can see here how high the digital penetration is. 98% of them are Facebook users. And sorry guys, you are much worse risk than girls are, so you can see the gender mix there. So finally, my last slide here. At the end of the day, we have to be mission-driven, right? Steve went before us and talked about responsibility, integrity, and confidentiality. He's left, but he'll be happy to know I remembered those. Some of you might have gotten scared when we talked about the types of data that we collect. But, you know, this is how I see it, and I think even Cesar mentioned this earlier this morning. If you can use that data with the full consent of the individual, you use it responsibly, right? And you use it for the purpose that you're asking it for, then why not, right? If we can give access to credit to these people through that data access, then why not? So we hold ourselves, our board holds us to a very, very high standard in terms of professionalism and customer centricity. So to give you an example, we are regulated with the National Privacy Commission. We employ a third-party data privacy agency that comes in every 30 days to do an audit on our data privacy practices. If we fail that, my KPIs go down, I get in trouble with the board, right? Although we're not regulated by the central bank, we also follow the truth in lending practices and we follow fair collection practices. So everything we do is above board and as professional, as responsible, using as much integrity as possible. And at the end of the day, it's about the customers' lives that are impacted and how we treat them with respect so that they can join, right, the formal financial sector. And you saw on the previous page, our repeat rate is about 60%. And you saw also the product roadmap. Our intent is to bring people in on a payday product, which tends to have a high interest rate. But then upon paying that, we migrate them into a cash loan product, eventually into a revolving line product, which has the lowest interest rate, right? So what we'd like to do is really bank these unbanked people, give them records, teach them and educate them on financial and responsible borrowing and lending, and bring them up the curve in society, right? So that's essentially what I had for today. Thank you so much.